Hello value investors, thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about LifeMD. What's interesting about LifeMD, why the stock is not one that you should be considering to invest in, and then I'm going to talk about what you're going to say in retort to that is that the stock is very cheaply valued. So let's just get right in. So this was a stock that I was invested in before and I took a huge loss here. And I did exit at this position, this position at a higher price, but I still took a hard loss. And I'm not some disgruntled shareholder or anything like that. I mean, in investing, you're going to take your lumps. I'm fairly okay with that. But I'm just going to go through and highlight 4 aspects that you could have also picked out in a few minutes, and you would have avoided your loss too. So here's the thing, right? If you are invested in LifeMD, you know this is a telehealth company, a telemedicine company, and one that is growing at a very rapid rate. You can see here in the graph that for the guidance for 21, it's growing at more than triple digits, right? Very compelling, right? Yeah. So I was also in that frame of mind, but anyway, that's how it is in life. So in the past 6 months, the share price has declined significantly. You can see the share price is down 64% in the past 6 months. Last night, it's fallen another 10% after hours. So let's dig in. So here, 4 things that you could have spotted if you had actually listened to this video. I should have listened to my own video in the past, and anyway, here are 4 things, right? The company has changed this name twice in the past. It used to be called Immunodyne, and then it changed its names to Conversion Labs, and then it changed its names to LifeMD. Okay, so straight away, since 1994, 3 name changes. It's clear that the company is trying to distance itself from the past. Next, they are diluting the shareholder at a rapid rate. So it finished in 2019 with 10 million shares outstanding, then it went forward to 2020 and it finished to 13 million shares outstanding, and then for Q1 it jumped to Q1 21 it jumped to 24 million shares outstanding. Q2 is now at 26. So with the passage of time, you can see that shareholders are getting meaningfully diluted out. Okay. Yesterday, after hours, they've announced that they're going to dilute they're going to release another 1.4 million shares into the market. So again, the same rinse repeat cycle. Okay, so the company is growing on top line. Terrific. It's guiding to grow this year at 145% year over year. Let me repeat that. As of Q2 21, revenues were up 145% year over year. Great, right? Triple digits. The problem is that it's on the EBITDA level, it's actually meaningfully going worse. So it's actually more unprofitable 6 times, nearly 6 times. You can see that in Q2 2020, it was a negative 2 million, and this time around it was negative nearly 12 million. So yeah, these are small numbers, and it's quite easy for me to say that the stock is the EBITDA unprofitability is down 6 times. But even if we exclude that, you can say, okay, they're growing the top line at 145%. Ideally, you don't really want to be incurring more than 145% on the EBITDA level profitability. Remember, EBITDA is heavily adjusted earnings, but if you look at the earnings, you see, roughly the same kind of idea, that it's gone from negative 3 million to negative 16 million. The next thing I wanted to highlight is that it had several auditors come in. So it has had Friedman since 2020 and Lakewood since 2018. So over time, you do kind of want, as a NASDAQ company, one of the big 4 auditing companies. You don't want to have some unknown auditor, and you certainly don't want a consistent change of auditor over time. You really want, it's kind of what you pay. Is in this business is how it is. You kind of want a good auditor. You want to trust the financials. Any one of these investments in and of its, any one of these insights in and of itself would have been fine. You would have been willing to disregard. Having these 4 points highlighted in the video to you and not doing something, kind of is difficult not to kind of take some kind of idea out of it. The other thing that I wanted to highlight is that the stock is priced at 1 times forward sales. Now, keep in mind that compared to let's say Teladoc, Teladoc is priced at 8 times forward sales, so obviously in comparison LifeMD is meaningfully cheaper. That being said, cheap can always become a lot cheaper, and this is something that has taken me a long time to learn. Now, if you want to actually get involved and find out stocks that I'm actually deploying my capital into, don't forget to check out my marketplace. It's called Deep Value Returns. I tell you the stocks I own, I'm telling you what I'm going to invest in right now. I'm going to take my experience from LifeMD and deploy my capital into opportunities that actually are going to meaningfully give me a return, a reasonable return over time. And also, you're welcome to check out the reviews of my marketplace and see what other people say in my marketplace. That's always a good place for you to start your due diligence. And yeah, you can unsubscribe anytime before the 14 days is out, and you're not going to get charged anything at all. In any case, hope to see you next time. Bye bye.